Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are talking all things global growth today.
We are.
We love talking stocks here, and we are joined by an expert all the way from Germany.
Yep.
Flew all the way out just to speak to us.
Yes.
Wanted to see the new studio.
Yeah, you heard about the new studio.
No, today we are speaking with Frank Thormann. He is a portfolio manager at Schroders Global Equities team, and he is responsible for Schroders Global Equity Alpha Fund. It's just listed here in Australia as an active ETF. The ticker is ALPH. And Frank's here to tell us we might be looking for growth in all the wrong places.
Absolutely. So a massive thank you goes to Schroders for supporting this episode and making all of our content free here at Equity Mates. But this was a great interview, Ren, because, yeah, it's a strategy that makes a lot of sense, but he's wrapped it all up and is now putting it into a fund that we can all invest in through the ALPH.
Yeah, I mean, for people who are long-time watchers or listeners of Equity Mates, we speak about the power of long-term investing, of cutting out the noise and thinking about the long-term opportunities with some of these companies that we're talking about. We also love talking about how the market's very emotional and how it can overreact and how those overreactions can create big opportunities. In fact, we talk about it so much, we've built a whole segment around it with Mr. Beta.
Yeah.
Well, rather than just us talking about it, Frank's doing something about it.
This is the professional Mr. Beta.
Frank is putting his money where our mouths are and has built a strategy around finding gaps between the company and the sentiment around the company, where the prospects and the sentiments differ. He calls it the positive growth gap. They're the companies he's looking for. Where he talks about some examples that are in the fund in this episode. We probably don't need to keep banging on about it.
No, let's get into it.
Throw to the interview with Frank.
Let's do it.
So without any further ado, here is our conversation with Frank Thormann.
Well, Frank, welcome to Equity Mates.
Thanks for having me. It's a pleasure to be here.
We want to start with your core investment strategy and process. Your fund focuses on finding companies with a positive growth gap. So can you explain what that is and I guess then how that materializes in practice?
So what that means is it's a fundamental bottom-up stock picking approach. So we try to find individual companies where we have high conviction in their ability to surprise positively versus consensus. So the name growth gap refers to the difference in our expectations versus consensus expectations. And the larger that anticipated positive surprise, the larger the growth gap, the more excited I get.
Nice.
Well, okay. I mean, to bring that to life with an example, can you give us an example of a stock that's showing that growth gap at the moment?
So one of our biggest convictions has been Netflix. So let's start with the company that everybody's familiar with, hopefully one that everybody loves. So as I explained, we try to assess a company's forward-looking potential. That potential is usually measured in earnings per share and compare that to published consensus expectations. So for Netflix in particular, we went into the position a few years ago. This is coming out of COVID. Back then, and it's a bit difficult to understand today, back then there was widespread skepticism regarding the company's ability to continue to gain subscribers, thinking that if you hadn't signed up during COVID, everybody and their mother had signed up, so when are you going to sign up? So the expectations were quite muted for this company. What transpired is people misunderstood the benefits of scale in the media business. And stating the obvious, it costs you the same to make a film, whether it's watched by 1 million people, 10 million people, or 100 million people. So by virtue of them having the largest subscriber base, they can invest, if they invest the same dollar amount per subscriber, mathematically it turns out to be a much larger amount than anybody else. So by virtue of outspending everybody, they're adding the most and the best fresh content to the library, and as a result, increasingly taking more and more market share from some of the weaker competitors. So as we've seen the last few years, they've been able to accelerate subscriber growth which definitely was a positive surprise and really accelerated the financial results, and a positive surprise, and it's been a very good investment.
That Netflix one is going to haunt me. It was, you look at the growth chart, and it was just, it flatlined for a couple of quarters, and it was around the same time that they got rid of all their Russian subscribers, and the shares were down like 70%? It's just a massive overreaction from the market. I guess, is that a key part of when when you're screening thousands of companies? Is that a key thing that you're looking for, like overreactions to perhaps short-term bad news?
So one of the market inefficiencies that we structurally like to take advantage of is exactly that. One, in my experience, markets tend to be myopic, too short-term oriented. Not surprisingly, we open the computer or the phone in the morning. We see the story of the day, what a company is telling us, what they've reported this quarter, what they're saying for next quarter. And usually it really pushes us into short-term thinking. As a result, consensus tends to over-exaggerate the short-term and lose sight of the long-term. So one attribute we try to exploit is deliberately looking long-term, deliberately looking where consensus is less crowded. The second point is often market underappreciates inflection. It's maybe natural to human thinking. Often when we think about the future, we extrapolate from the past. We take out the ruler and we expect things to continue the way they have been. And I think extrapolation is a reasonable approach in many instances, but not in all instances. So deliberately, this strategy tries to find not hundreds of companies, 40 to 60, where we have strong conviction that there's something happening that serves as an inflection, and importantly, it's not recognized by consensus.
Are there any particular sectors or regions that you're finding a lot of opportunities popping up at the moment, or I guess, like industries within markets?
Yeah, so the investment approach I think you're alluding to is a top-down approach, where often global portfolio managers will look at the world, try to ask the question which country, which sector is seeing the most favorable trends, and then within that bucket, what are the most attractive companies? We kind of do the opposite. We really approach the world from a bottom up, really starting with what's happening inside a company that is misunderstood. And I think the Netflix example is a good one, where we didn't ask the question what's happening in the media industry. We asked the question, this company, through its own innovation engine, is really going from strength to strength. And so it's very much a bottom-up, company-specific investment strategy.
So you mentioned a few sort of factors that you're looking at there, that sort of overreaction to short-term news and discounting the long-term opportunity, or perhaps an inability to think exponentially or to understand an inflection point. When you're looking for those signals in like company results or earnings calls, like what's the signal amongst all the noise where you're saying, I think there might be an opportunity here that perhaps other people are missing or discounting?
Well, luckily, I don't have to do all of this myself. So literally, there are, as I say, there are hundreds, thousands of companies. So I'm really blessed to be working with a super talented group of analysts. There are roughly 15, 16 analysts we have that are responsible for their respective sectors and usually have decades of experience, knowing these companies inside out. And then you challenge ourselves to be very, very close to these companies. We meet them regularly. We speak with the management teams. We speak with the competition. We speak with the suppliers. Always asking the question, what are the changes in the industry, and importantly, what hasn't been recognized by consensus? And maybe just to give an example, and often it's the side remarks, for example, that can be really insightful. If I'm meeting with 3 companies in a sector and they're all saying, well, we're doing really well, but if it weren't for this annoying competitor, we'd be doing even better.
Yeah.
Well, maybe that's a suggestion to go speak to the annoying competitor and see what they're doing so well.
Yeah.
So it's really a puzzle theory of always keeping your ears and your eyes open and seeing where change is happening and where it hasn't been recognized by consensus.
Does an example come to mind there of something that was maybe like a side comment or just an off-the-cuff remark by a couple of different CEOs that sort of sparked an avenue of inquiry that led to an interesting opportunity?
Yes, using the example of Microsoft, one I think underappreciated benefit is, let's call it their seat at the table. as in, maybe for the listeners, we perhaps all use Microsoft products at home, but virtually all of the revenues and all of the profit Microsoft generates are from enterprise customers. The consumer business, they run, how to say, a bit of a, I want to say loss leader, but all the money is made with the enterprises. So they will each year meet with each chief technology officer of all large enterprises across the world. That is an amazing opportunity to cross-sell. And trust me, they
do.
And trust me, they do. So, for example, remember going back to COVID when we were stuck in our basements, we spent half our lives on Zoom calls. Well, what's happened to Zoom? Lo and behold, 6 months later, Microsoft comes out with Teams, and they give it away for free. 6 months later, they meet with the chief technology officer and says, well, we've observed you're using our products a lot. Here's the contract for the next year. And by the way, it's up 10%, and then they price for it. And here we are today, and Zoom stock price is down 90%, and Microsoft stock price has doubled. And it's just, not just designing good products, but then being in a pole position to push it and to sell it. And I think probably nobody does it better than Microsoft.
Yeah.
So your fund typically holds 30 to 50 stocks. How do you think about portfolio construction? Like when you find a company that has a big positive growth gap and consensus and your expectation is far apart, I guess as that closes, are you selling those stocks and rotating out, or like how long do you hold those positions for?
So the magnitude of the growth gap is what calibrates the potential upside. The larger the growth gap, the more excited we are, the larger the anticipated positive return. At the same time, everything we do, we try to do on a risk-adjusted basis. So in addition to this positive growth gap, we have what we call a fundamental risk framework, where we ask the question, well, what if you're wrong? I wish I had a crystal ball and had perfect foresight, but I'm the first to tell you I make a fair amount of mistakes. And then it makes a big difference if the stock is down 20% or the stock's down 80% if I'm wrong. And to answer that question, we have a fundamental risk assessment where we score a company on several different risk attributes, such as financial leverage, how much debt there is, but also some qualitative measures. How good is the management team? How competitive is the industry? How conservative is the accounting? And all of that, we build a weighted average, and that's a risk score. And to bring it back to the question on how do we weight positions, so the larger the growth gap, the larger the position size, and the larger the fundamental risk, the smaller position size. So it's a combination of two with the intent to have positions that are risk adjusted.
Yeah, nice.
So Frank, we want to turn to, I guess, what you're seeing in markets today and where you're seeing opportunities. And I feel like it wouldn't be an investment conversation in 2025 without those two letters that has got everyone excited, AI. So I guess, what's your view on AI generally? And then beyond sort of Mag 7 and that mega cap conversation, where are you seeing sort of sustainable opportunities being built in this space?
Thank you for the easy question. So AI is by some distance probably the largest, the most powerful theme we've seen washing through the equity world probably since .com. And the magnitude of investment that's going behind it is probably putting .com to shame. It's probably no stretch to say that it is by some distance the most important decision one can make. So if one had perfect foresight, you could make a fortune out of this. I think it's also important to be humble and recognize where we have foresight and where we don't. So I think without question, this technology has amazing potential. At the same time, when I meet with companies, when I meet with CEOs in every conversation, I will ask the same question that you just asked me. So tell me, what are you doing with AI? Like, how is this changing your business today? Give me a real world example of how it's revolutionizing the way you do things. And frankly, for the most part, it continues to be somewhat disappointing. So usually companies will tell me, well, of course, they have some examples prepared to make them look good. But
Yes.
we're piloting this.
Yeah.
We're doing this and that. So what's been the outcome of this? And often it's quite small, and I would characterize it as more in the test phase than the implementation phase, which is to say it's a technology with lots of potential, but also for the most part relatively nascent and unproven. And maybe just to bring it back to a specific example, we all know that at the moment the error rates, what are called hallucination rates, are still easily in the double digits. Now let's take a bank that's highly regulated. If 10% of your responses are wrong, well, that doesn't go over too well with the regulator. It just doesn't work. You have to be almost error-free. So the big challenge, especially for enterprises, is how do we take this really high potential technology and get the error rate down to something that's acceptable to regulators, to customers, to our business. Same with accounting. Well, the accountant will tell you, well, the numbers have to add up. They have to add up exactly. If you are wrong by 10%, that just doesn't work. So I think that'll be critical in sizing this opportunity, whether it just stays more of a consumer application. You take out your phone, you ask ChatGPT a question, whether it's right or wrong is not going to make or break your day, or is this a business application where it has to be correct every time?
So hearing you talk about that, and I guess talking about how a lot of companies are sort of in that test and trial phase, it reminded me of a study that came out from MIT recently that had 95% of generative AI pilots not creating any values for companies yet. So I guess when you're on the road and speaking to companies, is that kind of the story that you're hearing? Like the excitement is there, but perhaps the value creation hasn't quite.
Well, when I speak to companies, they definitely don't tell me 95% of their pilots have failed.
Yeah, that is fair.
They usually try to they pick out the 5% that have worked well and talk about those. But to your point, I know full well that they're not talking about the failures and put themselves into a good light. And there's a big part of my job is to bring a fair amount of skepticism to the conversation, and knowing that.
Yeah. So then from putting your investor hat on, when you approach investing AI, trying to navigate all the hype, how are you navigating it? Are there any AI investments you guys are making, or are you kind of trying to steer clear and look sort of beyond this hype cycle?
So for global portfolio managers, there is a lot of temptation to try to be a hero and make a really big call on this. Stating the obvious, had I gone all in on AI 2 years ago, it would have looked like a mastermind. Had I get this completely wrong, you look like an idiot. So you can bet the farm on this and try to be right or wrong. So deliberately, us in this strategy, we try to do the opposite. So we try to find 40 to 60 companies that are independent and uncorrelated of each other. So as a result, we have some investments that benefit from AI, but by no means is the majority of the investments we make going on all in on this AI theme. We to bring it back to company specifics, just maybe to highlight 2 companies that I'm excited about, where I can see tangible evidence of them really benefiting from this. The first one to mention is the Meta company. So this is Facebook and Instagram in particular, where they are showing very impressive, tangible results in advertising targeting. So maybe take a step back. Old school advertising. There's the old saying in advertising. 50% of the advertising budget is wasted. I just don't know which 50%. That's when you have a TV advertising, you show it to 1 million people, and you have no idea who winds up buying the product. Yeah. The internet comes along and revolutionizes this, in that there is much more measurability. You can show an ad, you can see people's response, who clicks on it, and it makes it much more measurable. As a result, let's take Facebook. They know a lot about you. They know who your friends are, who your interests are, what you've liked. So as a result, they can show you really targeted advertising. That was last year. Now what they're working on, which is pretty amazing, if for some people a bit scary, is that going forward, they are going to be customized advertising. So no two advertisements are going to be the same. So they are going to show you an ad, perhaps in the same place where you spent your last holiday, perhaps with a dish that's your favorite food, perhaps your favorite song playing in the background, surrounded by people who you find beautiful, and it's just perfectly mastered to your tastes. And guess what? Your click-through rate is going to be much, much higher than just showing a generic advertising. So doing this on a case-by-case basis, and not just image, but doing this in video, in real-time basis, and that's powered by AI. So
crazy.
That is pretty crazy.
Yeah.
Frank, you obviously love talking about stocks. I'm sure there's, many that we could go through. Can you give us a sense of perhaps some non-tech companies that are in the portfolio? Perhaps some European ones.
Of course. So far, we've mostly discussed companies that everybody knows about, solidly in the growth space. Maybe darlings. So I don't want to leave you with the impression that that's all we do. So I appreciate the question. For example, we have significant investments in European banks.
Okay.
Let's take Intesa as an example, as an Italian bank. Often when I mention this company, people look at me and says, Italy, banks? Wasn't Italy the segment of Europe? Weren't they going bankrupt? Wasn't there a big debt crisis? Well, that's more than a decade ago. Little by little, Italy's really been right-sizing their fiscal, their budget problems. As a result, the market's perception of the Italy sovereign risk has dramatically fallen. And obviously, as a bank, the country sensitivity is important. In addition, Intesa, in our estimate, is the best managed bank within Italy. How do you run a good bank? It's like you run most good businesses. You take care of your customers. You treat them well, good customer service. You have good products. You don't cheat on hidden fees. It's fair. It's clean. It's clear. As a result, even in a country that's not growing much, even in a country with unfavorable demographics, they've been able to produce reasonable number of loan growth. And we're not talking about dramatic amounts of growth, but remember, in the beginning, we talked about everything we compared to expectations. And this is a super low expectation stock and a super low expectation sector. So moderate growth can be a really powerful positive surprise if the expectations are really low. They then cross-sell successfully into higher margin products, insurance products, asset management products. So despite little or no industry growth, they've been able to produce really solid earnings growth, much better than expectations. And then one additional benefit, we haven't discussed capital allocation, is another important aspect in investing. If you're not growing, you don't have to put down much additional capital as a bank. So all of the earnings have been available for distribution. So they've been paying really high dividends, share buyback. It's all come back to the shareholders. And it's been a really powerful recipe for a strong share outperformance.
Love it.
While we're talking about Europe, I'd love to know, so you've just been doing a roadshow around Australia. You've been speaking to a lot of Australian investors. For people who haven't picked up your accent, you're from Germany, but you work in the UK, so you've got your finger on the pulse of what's happening in Europe. As you've been going around Australia and speaking to Australian investors, I would hazard a guess, and correct me if I'm wrong, I would guess that first of all, a lot of Australians are underweight Europe in their portfolios. And secondly, I'm sure you're hearing some misconceptions around Europe. A classic example that you were talking about there around Italian banks. What are some of the what don't we as Australians understand about Europe? What do you want us to know better, or what do you want to change our mind about?
Well, it's a bit of a dangerous question. It's my first time to Australia.
Oh, really? Oh, welcome.
Yeah.
Thank you. So I think you're in much better position to assess what the average Australian investor ticks like. Maybe to turn that around, in most places I visit, I observe a home country bias. That's true for European investors. I think it's probably fair to say that's true of Australia. And I'm a big fan of psychology, and it's just part of human psychology is something that's closer to home, feels more comfortable, feels more natural, and as a result, we have higher conviction. one piece of advice, really for investors anywhere, is to think more globally. By limiting yourself to a small subset of global equities, whether that be one country, one region, or one sector, you're really missing out because that particular country is not going to do well all the time. And so it's the benefit of diversification.
So Frank, in one of your recent papers, you showed that the average holding periods for stocks over the last 50 years has gone from 5 years to just 10 months. So I think the first part of the question is, why is that? And secondly, does that present an opportunity for us as retail investors?
Yes, it does. I think the reason that's been happening is coming back to the beginning of our conversation, is just people becoming more and more myopic. We open the paper, we see what's been happening today, information travels more quickly, and then the other important change in the structure of the market has been growth of hedge funds that typically act daily rather than annually. There's been algorithmic trading, market rebalancing, and all of that lends itself to just really short-term thinking. And the consequence, as you point out, has been much, much shorter holding periods. So what's the implication for professional as well as retail investors, really, is I think it's important to be clear about when you're acting, whether and to what where you want to differentiate. So I would suggest, if you're trying to compete with the super fast money, with the algorithmic trading, with the hedge funds, well, good luck. That's probably a losing strategy. If you're doing what everybody's doing, well, by definition, that's not very differentiated. So I'm a big fan and believer in more long-term thinking, really trying to think out 3, 4, 5 years. And then, by the way, as a retail investor, you save yourself lots of headaches and lots of commission. Okay. So I would suggest think more long term.
So when we talk about the short-termism of markets, it's been a bit of a conversation recently around this quarterly reporting and the suggestion that we should change from quarterly to half-yearly reporting. Do you think that would change our short-termism in markets, or do you think it runs deeper than that?
Perhaps a bit. At the same time, well, it's beholden on all market participants. It's beholden to us as investors. If I meet a company and the only thing I do is ask your short-term questions, not surprisingly, the company's management will turn around and what are they going to tell their team? Make sure the quarterly numbers match up. Yeah. And so it's a bit of a collective vicious cycle. But at the end of the day, everybody makes their own decisions, and start with myself and start to look more long term.
Well, if it is incumbent upon us as individuals and the team that you manage at Schroders, how do you guys build a process that keeps you above the short term noise and focused on the long term? Like, do you have particular sources of information you prioritize, other ones you discount to rise above it?
That's probably one of the most difficult elements in our job. We don't want to put our head in the sand and be blind to short-term events. They can be very informative. But always asking the question is what's happening today, what does it tell me about the longer-term future? Is it just noise? Is it just an air pocket? Is it just a coincidence? Is it a lucky accident? Or is it the beginning of a more stronger and durable trend? And trying to make that differentiation is important and not easy.
Yeah. It's the $1 million question, literally.
Are there any, I guess, company leaders that come to mind through the experience you've had that really have been truly long-term in how they approach their business? Because I think, we talk a lot on the show about how incentives are so tied to short-term behavior for a lot of executives, the thinking that can drive. But just, are there any sort of long-term thinkers that have really, I guess, impressed you over the journey?
Well, the one person that comes to mind is Warren Buffett.
Yes.
I think he's been exemplary in his ability to tune out to short-term noise and really focus on the long term. So he's never given financial guidance. He's deliberately told all his teams, you do what's right for the long term. And if that means there's short-term noise, as in short-term bad results that are published, that's fine. Just do what's right for the long term. And he's been super successful in that pursuit.
Yeah. Well, if you find the next Warren Buffett, let us know. So I want to unpack your process a little bit more, because I think what you've explained so far about finding a positive growth gap makes a lot of sense. And some of the examples where that growth gap may materialize, I think people can intuitively understand and think about examples where they may have seen that before, where we've overweighted the short term and underestimated the long term, or haven't really truly understood what, a exponential growth could look like for a company. The challenge then is not only finding the positive growth gap, but then thinking about when the rest of the market will wake up and realize what you have realized. Because sometimes you could identify something years ahead of the rest of the market and hold a position that sort of treads water or goes backwards, even though you may be right. So how do you think about the timing when it comes to a portfolio like this? How important is it to have like a near-term catalyst, or are you happy to hold and wait until you're proven right?
So in addition to having this longer term growth gap as aspiration, really importantly, we also set shorter term milestones. And the danger clearly is that you find something, you fall in love with a concept that's several years out, and you lose sight of the fact that there are disappointments today. Maybe those disappointments today turn into disappointments this year, turn into disappointments 2 years, and then you find yourself 2 years down the road, and it's just been a terrible decision. There's no, you were just wrong on the positive.
Yeah.
So at what point do you realize that you're wrong on the positive growth gaps? So importantly, I have to identify something that gives that conviction in the company's ability to surprise positively, but then we set milestones, which are usually quarterly. So every quarter when a company reports, we assess, are these positive surprises actually coming through today? Is there evidence today that this is happening, that the company is starting to surprise positively? If that happens, for us, that'd be a signal to increase conviction and position sizes. And then on the flip side, the sell discipline is the exact inverse. So if a company falls short, doesn't deliver on the milestones today, well, then I have to ask myself very difficult questions. Is it just an air pocket? And believe me, companies are really creative in telling me it was just an accident. Believe me, next quarter is going to be great. Sometimes it is, but sometimes it isn't. And sometimes, frankly, I was too optimistic. And then it's really important to catch those mistakes early and be disciplined, and then sell the stock. And so the delivery of the milestones is the key way we make that distinction.
Yeah.
Well, Frank, to close out, can you give us a sense of how Australian investors or and retail investors should think about the Schroder Global Equity Alpha Fund as part of their portfolio?
So it's a concentrated, meaning 40 to 60 stock portfolio of best global ideas. So I would definitely suggest people consider it as part of their global equity allocation. We have the aspiration to outperform the global benchmark, as in the global equity averages, by roughly 3 percentage points per year, which we've been able to deliver historically, and be able to do that in a way that's risk controlled. So as we've described, it's not a strategy that tries to be a hero going all in on one particular style. It's not a strategy that's just really high beta, as in buying very aggressive pro-cyclical companies. Works great in 1 year, works terrible in another year. It's really based on 40 to 60 stocks that are independent of each other. And as a result, the intention is to deliver those returns in a consistent fashion.
Well, to close it out, Frank, the great thing about active ETFs is that more and more opportunities are coming to market for people like Bryce and I. So as we consider our opportunity set and think about ALPH relative to other active global equity managers out there, what's your elevator pitch? Give us the reason we should be thinking about this one in the portfolio over some of the other ones out there.
Thanks for the opportunity. The elevator pitch is that everything starts with a philosophy. Markets are really inefficient. We think we have identified a persistent market inefficiency with this growth gap in looking for companies that surprise positively. And in most market environments, positive surprises are rewarded with stock price outperformance. we take that as a best ideas approach across the world, finding 40 to 60 stocks which meet that criteria. We put that together in a risk-adjusted and diversified manner. And in addition, we have a track record that supports the fact that we've outperformed global averages historically.
Nice.
Love it. Well, Frank, thank you so much. We really appreciate you coming all the way from Germany just for this interview. No, I'm kidding. Welcome to Australia. But we certainly appreciate you taking the time, and I'm sure a lot of the listeners today would have taken a lot of value out of that conversation. So thank you so much.
Thanks so much for having me. I enjoyed the conversation.
Thanks, Frank.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.